more than you think. So in this video, I'll be sharing some of the reasons why you should consider not buying a car on credit, because it can cost you more in terms of interest rates that you'll be paying. The value of the car will just depreciate and you won't be able to save enough money. So I was reading an article on CNN news report. It was showing that during the first quarter, a car loan interest, the first quarter of 2024, a car loan interest, a new one, was 6.73% if you're buying a new car, and if you're buying second-hand, it was 11.91. So that's the interest that you pay towards buying an old car and buying a new car. And it went on to say that all these interest rates were also determined by your credit report. So if your credit report is poor, you pay more on interest because they think that you will default, and then they'll make you pay double, basically, from a person who has a good credit report. So I was like, okay, this is shocking. And then it went on further to show that when you apply for a car loan, the lender will review your credit score, and then they will give you an interest rate based on your credit record. So let's see. So if your credit score is between 781 and 850, that's the best. If you are at that rate, you will be offered a 6.80 on a used car, and on a new car, you'll be paying an interest of 5.38. And if your credit score is between 661 to 780, on a new car, you'll be paying 6.89, and on a used car, you'll be paying 9.04. So you see, if your credit score is poor, you pay more on interest rate. And if your credit score is good, you tend to pay less of the interest rates. But it's still a lot. Imagine, even if your credit score is good and you are paying 5.38, it's a lot, because there's no bank that's offering you that much in terms of the money that you're putting in the bank when we're talking about savings. Because at the moment, my interest rates on saving, it's between 2% and 3% here in the UK. I don't know on other countries. In South Africa, it's a bit better because you can still get something like 7% going to 8% per annum, but it depends on the country that you are based on. So you see that it doesn't make sense for you to buy a depreciating asset on credit and you end up paying more on that asset, on that product that you are thinking it's an asset. So let me tell you a story. I'll start by telling you a story. This was the mistake that I made when I started working. So I started working in 2012, and then in 2013 I bought my first car. So that was really a biggest mistake that I had made at that time, because I didn't know that there were certain things that I needed to look at when it comes to buying a new car. Firstly, I didn't know that I had to look at the interest rates. Like what I was saying, though my credit score at the time was an okayish, because I was still new in the industry of working. That was my first job. So my my interest rate, sorry, it wasn't so bad, but I was still paying around 10% in terms of interest rates on the car that I bought at the time. So another thing that I didn't consider when I bought my first car was the fact that because I was a new driver, it meant that my insurance that I was going to have on that car was going to be more. So it ended up taking a lot out of my salary without me realizing. Firstly, the car that I was paying for, I was paying something around 3,000 rands because I was still in South Africa at the time. And then insurance, because I was still a new driver, I was paying around, actually it was 2,000 at first, but then I had to shop around as I go to make sure that it goes down. So all in all, I was having 5,000 that was coming out of my salary, that was going to car payments in terms of paying back the loan plus interest and then paying for the insurance. 5,000 was already gone. I did not include petrol. So then for me to move that car, it meant that I had to budget a certain amount of money every month for me to to move that car. So that meant petrol. So I would say my petrol for the month was around 1.5 to around 2,000, depending on what I was doing per month. So I would say roughly, combining everything, I would say around 7,000 was coming out of my salary, going into servicing the debt of the car and also uh, maintaining the car. I remember, because I was still a new driver, I I had a minor accident because I was still learning also to drive. It was a new car and everything. So the bumper got damaged. And when I called my insurance, they told me that I had to pay an excess of 4,000 rands for me to get that bumper fixed. And I was like, what? I don't have that kind of money for me to pay towards an access on the insurance for them to get the car fixed. To be honest, I left it as it is until to a point where I had to sell it. So to make the story short, I had to move to the UK in 2016. So I was paying for that car for almost 3 years. And when I was about to sell it because I was moving to a different country, I realized that I was, for the first 2 to 3 years that I was paying towards money for that car, I was actually uh, paying interest, not paying for the principal of the car. So I was like, okay, so you are telling me that I'm left with 80,000 to pay, and I've been paying this car for 3 years. Because when you're still new into this working life, and you think that when you get a new job, you have to start by buying a car, buying nice clothes and all. I didn't realize that it was costing me a lot of money, and it was causing a financial strain each and every month. Looking back now, I actually realized that I wasn't affording the life that I was living. The good thing that came out of it was, because I was still living with my parents, I was not paying rent. It alleviated a bit of pressure on my finances. But if I was paying rent, or maybe working far, and the good thing was I was not working too far from home, because I was a teacher back then, where I was staying when I was still at home, so it made things a little bit easier. But if I could factor in rent in the process of all the financial situation, it meant that I was going to be living paycheck to paycheck. Back then, that was 2012, 2013, 2014, around 7 8 years ago. So it just shows that getting a car on credits, it's really not a good idea. Because to be honest, imagine if they are saying that for a new car, the reports now are saying if you're buying a new car, you'll be paying 6.83 on your first car, sorry, 6.73. And if it's a used car, the interest rate is between 11% 0.91. So that's a lot. That's a lot. So here are some of the reasons why, and it will correlate with the story that I've just told you now. When I bought my first car, when I said I made the biggest mistake that I shouldn't have, I should have saved for the car and bought it cash. Then I would have just have been worrying about the car insurance, or maybe then saving for maintenance. Because at that point, I couldn't even afford to save money for the maintenance. So it was not a good situation to be in. So let's talk about the reasons why you should consider not getting a car on credit. Number one, because of high interest rates. Because let's face it, at the end of the day, you end up paying more than what the car is actually worth. So basically, if I buy a new car today and it's around maybe 15,000, and I take it out of the garage, the moment I leave, it starts to lose its value. So I will end up paying for that car for a term of 5 years, usually for cars, or 6 years. I don't know what's the time at the moment. I think in South Africa it's still 5 years if you're taking a car on credit. So imagine you take it out of the garage today and you start driving it, it depreciates. Just like the story that I was telling you, that I had a minor accident because I was still a new driver. So what happened is, when I called my insurance and said, can I get the car fixed? Because I thought, okay, I'm paying for an insurance. And then they told me stories that you need to pay an excess of 4,000 rands. And I realized that I don't have that 4,000, and I was working. I don't have the 4,000 to pay towards the excess. So just know that the moment you see interest rates, so you need to really, really think carefully on when you want to buy a car? Do you really want to get it on credit, or do you really want to save? Because let's face it, if you try and sell it a month after you get that car, trust me, it won't be worth what you have just bought it for a month before. So that's one thing you need to consider, that you'll be left with a debt that you'll be paying for, but the car will be valueless. So that's why I say that it's not really a good idea to get a car on credit. Number two, it depreciates. It's a depreciating asset. So imagine you are still paying for that thing for a term of 5 years, and then when you're trying to sell it, you can't even sell it for what you got it for, whether new or used car. You will never sell it for what you got it for. Because I remember when it came to selling my car in 2016, because I was moving to another country, I couldn't even get a cent out of it to say, okay, I've had this car, because I thought it was an asset. I couldn't get it. I couldn't get the money back. I realized that I just had to settle to what the buyer was offering me so that I could settle the outstanding loan. And fair enough, and I was lucky. The person who bought it just said, I'm just going to clear your loan, and I didn't have to pay extra. So one thing you should know is, if something happens on that car and you still have a loan on the car, and you don't know how you're going to settle the loan, you will still continue on paying it. If maybe an accident happens and your insurance is saying we can't write it off, you will still be left with the loan, and you will still be paying for it, maybe without even have a car. For my situation, when I'm saying that, I was lucky that the buyer who bought my car actually settled the full loan that was still outstanding. If maybe he was offering less than what I wanted, what could have happened is I would still have to pay for that car, and I wouldn't have been having the car because I would have moved to a different country, but I still would have been having a loan that I had to settle. So just know that it's a depreciating asset. So the moment you take it out of the garage, it loses its value. So you'll still be paying for something that you will never get money back with. That's worth the car that you have. So even if you're saying it's the most expensive car, if you get it for 1 million today, just know that there's a possibility that you will sell that car for less than 1 million, but you will still be having debt that you are still paying for a term of 5 or 6 years. So that's one thing to consider. Number three, it causes a strain on your finances. Imagine if you're like what I was saying, I had almost 7,000, by rounding it off, like I said, that was coming out of my salary each and every month for having that car, paying for the bill, paying for insurance, and also petrol. So I knew that I had to be committed into paying that loan. So it causes a financial strain on your finances, because imagine if you have 7,000 coming out of your salary each and every month, and it means that you never have enough to either save or invest if you're not earning a lot of money, because you have that a loan that you still need to service. So it's very, very important to also consider the fact that it will put a strain on your finances, and you end up being in a limbo of living paycheck to paycheck. So it's very important for you to also consider that part, to say, okay, is this going to put a strain on my finances if I buy this expensive car on credit, depending on what you want? Will it put a strain because you know what you are earning? Is your salary going to manage to cover for the expenses of the car, which is the car loan, the insurance, petrol, probably maintenance along the way? Is it worth it having a financial strain on your finances just because of a car? So that's one thing you need to consider. And number four, it will have an impact on your budget. It will have an impact on your budget, because you can't budget for anything else until you finish paying that car within a term or a specific period of 5 years or 6 years. So it will have an impact. It means that you can't do anything else. You can't plan. For example, you can't say, okay, let me work on this financial short-term financial goal. But if you have 7,000 or 8,000 coming out of your salary each and every month just going on a car, what else are you going to do except to take more debt for you to be able to live? So it means that you end up going back to the bank and say, okay, offer me a new loan, maybe a personal loan or maybe a credit card, so that you can live on your day-to-day life. Because imagine if already 60% or 70% is coming out of your salary, just going on a car payments and petrol and maintenance, it means that it becomes a lot, so it impacts your budget and you can't do anything else for that period of 5 years. For me, I feel like it's a lot, and I will never repeat that mistake again. If I need a car, as I've said before, I would rather budget for it and buy cash, and then I know that I will have to worry on insurance and probably maintenance, but not worry about paying back the loan for a term of 5 years, and I'll be impacted for a period of 5 years without doing anything, because I'll be servicing the debt for that car. So that's another thing to consider, that it puts a financial strain on your finances and it will impact your budget. So it's very, very important that you also consider that when it comes to buying a car on credit. And the next one is that it's a long-term debt. So what that means is that, just know that you will have to be committed to paying that car loan for a period of 5 years or 6 years without you doing anything substantial. Sometimes, like what I've said, it means that it forces you to take more debt because it has impacted your budget and you can't do anything else because you have bought that car. Probably you're saying, okay, I've just finished my varsity education, let me get myself a car. But to be honest, I realized that we put ourselves in these financial constraints that we can't seem to get ourselves out of, because most of the time we just want to live for people rather than ourselves. So that's one. Those are the things that you need to consider before you start buying a car on credit. Trust me, it's not worth it. I say it's not worth it because I've been there, and it's not a good position to be at. If you are having a car taking almost 60 to 70% of your salary each and every month, what else are you gonna do? If you are you have to pay for your rent, you still need to buy food, you have kids, probably you still need to pay for school fees. What else are you gonna do? Is it worth it? I say it's not worth it. It's not worth it to buy a car on credit because it will put you in a difficult position that you won't be able to get out of, unless now you start coming up with a plan for you to pay that debt quickly by putting in extra payments. So it's important for you to rethink it. So here are some of the reasons. Let me recap. It will put a financial strain on your finances. It will impact your budget. The car depreciates, so when it's depreciating, just not know that it's not worth the money that you have bought it for. And the interest rates are just too high and it's not worth it. If you are paying anything from 6% or 7% of interest on a car loan, and when you know very well that you can't get that much on your savings, the maths just doesn't make sense. So it's not worth it for you to do it. So I do hope that this video will give you some light before you start going out to take credit for buying cars. That's all for today's video. Bye.